app. It's connecting to a, just give me 1 second.
Yes, Miss. Now it's all okay.
Right. Thanks, Astrid, for that. Can you hear me now?
Yes. Miss.
Okay, right. It's because it was connecting to a Bluetooth speaker. Okay.
Oh.
So what I was saying was, like I said last week, we will be focusing on MCQs today. Okay. The reason is because 60% of your marks is going to be based on an MCQ. Okay. So if you're not going to be good at MCQs, no matter how well you practice constructed response, because at one point you will be confident with constructed response questions. Okay. But if you're not confident with an MCQ, that is like, you will only be able to get a maximum of 40% of your marks. The remaining 60, you will not be comfortable, which is not a good thing. Okay, so let's go through a few MCQs, and I have chosen the specimen exam. The reason is, one, everybody has access to it. It's at the back of the revision kit. If not, you can download it from Google, or if you go to the ACCA Global site, you have access to the specimen paper. But with the ACCA Global site, the issue is they don't allow you to download it as a PDF. Okay, so how it goes is they give you the exact platform that you will have when you're going to sit for your paper. And you will be expected to, like input all your answers into that system, and then you can check later on. So the issue is you won't be able to see the question and the answer at the same time. Okay, so a better option would be just Google FM specimen paper, and you will be able to download a PDF version, which is a lot easier to, like to learn what the paper is trying to say. It's easier to have a PDF. If you want to check, what are the tools that you have when you're sitting for FM, how the system looks like, in that case, you can go ahead and have a look at the ACCA Global website. Okay. So that's the reason why even in your revision kit, you can see the question is like really small and you can't read properly. The reason is they have also taken screenshots from the platform and tried to put it over here. Okay. Right. So the good thing about doing MCQs in a paper, why did I choose a paper? Why am I not just picking questions? It will cover a lot of areas. Okay. Because it is like a real life paper. No? So in the real life paper, they want to cover their aim is to cover 100% of the syllabus, right? So here, since this is mimicking a real paper, you will see a lot of syllabus coverage. Okay. So how this will work is I'll give you some time, maybe about 2-3 minutes to have a go at every question. And then I will go through the same question with you. If I feel that, this is an area where we can discuss a little bit, if there is a theory behind it or something like that, I will go to slides and we will go through that particular area one by one. Okay. Right. So like I said, specimen exam, you can see it says section A. This section of the exam contains 15 objective test questions. Each question is worth 20 marks and the section is worth 30 marks in total. Okay. So 30 marks means, first let me tell you how long you should be spending in this area. So when it comes to your ACCA papers, guys, remember every mark you can spend about 1.8 minutes. Okay. So this area, you can spend about 54 minutes of your exam trying to figure out answers. Okay, so 54, try to aim between 50 to 55 minutes. By then, all these 15 questions should be done. Okay. Right. So let's go through question 1. It's saying, the home currency of ACCA company is the dollar, and it trades with a company in a foreign currency whose home currency is the dinar. The following information is available. So they're giving me the spot rate. Then they're giving me the interest rate in the home country, inflation rate in the home country, and interest rate in the foreign country, as well as inflation rate in the foreign country. It's asking you, what is the 6-month forward exchange rate? So what you have to think here is, is there a particular equation that we have that will connect the forward exchange rate with either the interest rate or the inflation rate, because those are the only two pieces of information that we have. What do you think? So take some time and figure out the answer there. Let me see if I have a better. I don't have a better copy, so we will have to make do with this version. Doesn't matter. Okay, then it's fine. Because if you can see it like then I have no problem. Usually this is a problem as in class because I put this on a screen, then only I realize this is online only, so not a problem. You have an answer. What do you think the forward exchange rate will be? A. Okay, great. So when I look at this, I can think of two different equations in mind, right? I have two things I can use if needed. One is the purchasing power parity theory and the interest rate parity theory. Those two things are the only equations where we talk about, the forward rates, the spot rates, and the interest rates. Okay. Now, remember here, what they are asking for is a forward exchange rate. Okay, so a lot of students get this confused, right? When you're talking about the forward exchange rate, you can't really use the purchasing power parity theory because in that theory, what you find out is a future spot rate. Okay, so if you take the purchasing power, you can have a look at that equation, the purchasing power parity theory, you will see that the equation gives you an answer for S1, which is a future spot rate. It's not the forward rate. Okay, so the only equation that will give you a forward rate is the interest rate parity theory. Okay, so what is that theory? It says the forward rate equals to the spot rate into 1 plus the interest rate of the counter currency divided by 1 plus the interest rate of the base currency. Okay, so what are they saying here? They're saying that the dollar is our base currency, it's our home currency. So over here we should put the dollar rate, and they're saying that the dinar is the counter currency. So here the dinar rate should be there. Okay, so we have everything that we need. Let's go ahead and plug in the values, right? So S naught spot rate is 20 into 1 plus interest rate of the counter currency. Counter currency was the dinar. So we're talking about 7%. But careful, right? Because 7% they're saying per year. We only want a 6-month forward rate. So we have to convert this into a 6-month rate. So I'll make it 6/12. Divided by 1 plus the interest rate of the base currency, which is 3%. Again, that is for the whole year. I will have to take 6/12. Okay, so you can put that in your cal as it is. And that should give you the answer for the forward rate. Which is, yes, 20.39. So the answer will be A. Right. Question 2, they're asking you, now whenever you see a paragraph, it's always a good idea to, read the requirement first. Then you can understand what we have to look for. It's asking what is the sensitivity of the NPV to a change in sales volume. So this is sensitivity analysis. Okay, so there was an equation that we can use to calculate sensitivity. And in this case, they are asking you specifically for sales volume. What do you think the answer will be? NPV over sales into 100, which is D. Okay, I mean, the answer D is correct, but the equation is a little wrong. Okay, it can't be NPV over sales because that means they will say the sensitivity of the NPV to a change in sales price. Okay, so it's not sales price over here. They're saying sales volume. Okay, so when it comes to sales volume, you have to remember that this is the normal NPV equation, right? The normal sensitivity equation, so not the NPV equation, the sensitivity equation is NPV over the present value of, sorry, there's some kind of a lag. Okay. Present value of the relevant cash flow. So whatever of, let me just say cash flow, whatever cash flow that they are asking for in the question, that particular cash flow's present value. Okay, so over here, they are asking me for the sensitivity of the NPV to change in sales volume. So NPV is very clear. I can just put the 1,300. But when it comes to sales volume, we have to consider something that will impact your sales as well as something that will impact your variable costs. Something that will impact your sales as well as something that will impact your variable cost, because volume, right? How much you sell, how many units you sell, that will impact your sales revenue also. It will impact your variable cost also. So the only term that actually takes both of them into consideration is actually the present value of contribution. Because you can see contribution, we take into account sales revenue as well as variable costs. So every time they ask you for sensitivity to sales volume, the denominator has to be contribution. Okay, so that will be 24,550 into 100. That should give you, so then I don't understand how you got the answer, though, Asjad. Yeah, so that will give you 5.3%. Right? Question 3, it's to do with just a theory-based question, nothing to calculate. What do you think the answer will be? Question 3. Okay, so here now in your exam, basically you will have to do like a matching situation here. Okay, because now you can see question 3 is saying, Gurdip plots the historic movements of share prices and uses this analysis to make her investment decisions. So there is a person, her name is Gurdip. She takes decisions based on historic movements of share prices. Okay, so what the share price was in the past. So based on that, she's taking her decisions. Another person, Oliver, believes that share prices reflect all relevant information at all times. So he is taking decisions based on all relevant information. Whatever information is available, he is taking decisions based on that. So it's saying match the level of capital markets efficiency that best reflects each of Gurdip and Oliver's beliefs. Okay. So this is something called market efficiency. Okay. So what is market efficiency? Basically, how fast the market, now let's just think of it like the stock market, how fast the stock market is reacting to any new piece of information. Okay, so there are different types of market efficiencies. I'll go through them one by one. Okay, there is one type of market called an inefficient market. Okay, now if a market is inefficient, what it means is the share price that you have, it is not an accurate reflection of whatever information you have available. Okay, so when you're talking about information available, think about it. There might be certain statements or, like an income statement or a balance sheet that particular company they released. Okay, but that kind of information is not reflecting in the share price because the market is inefficient. There can be inside information. Inside information means, let's say, this particular company, people within the organization, the high level, the directors, they tend to know that we are not doing so well. Okay, they might know that, okay, fine, in the next 6 months, the company's performance is going to drop, but nobody else knows it. It's private information. Even that kind of information, it doesn't reflect in the market price. So when you're talking about an inefficient market or not efficient at all, the only thing that will be there to help you take a decision is historic prices. Okay, so if you see, okay, in the past 10 years, prices have increased, then you can assume that, okay, this company is doing well. If prices have decreased, you will have to assume that this company is not doing well. So with regard to an inefficient market, we don't reflect the available information in the share price. Okay, so that is an inefficient market. Right, so then we have a weak form market, a weak form efficient market. So what do we do here? We reflect all past price movements, right? So all past price movements. And in addition to this, if there was some past information, a past statement or something that was, made available, then that will also be reflected in a weak form efficient market. Okay, so any other information that was, let's just say, publicized. Okay, that is weak form efficiency. Then we have the third type of market called a semi-strong form market. Semi-strong form efficiency. What this means is we reflect all past price movements and we also reflect all publicly available information. What that means is, let's say something was released in the news. Okay, let's say one of their factories or something, it caught fire and the company themselves, they didn't come and say anything, but this particular information was released in the news and as a result, share prices, it came down. Okay, so then what has happened? We are reflecting all publicly available information. So that way we are semi-strong form efficient. So we are not just, reflecting anything that they have publicized. Formally they have publicized. We are even reflecting any informal public information. Okay. Finally, you have a strong form efficiency. What that means is we reflect all public and private information. Okay, so this is like, for example, there was some private information. Maybe let's say that particular company, they have, decided to invest in another completely different industry. Nobody knows about it except for those within the organization. But inside, you have somebody who is giving you inside information. So based on that, even though the data is not publicly available, the share price will reflect even private information. Okay, so these are the 4 types of capital markets you can have. Okay, so based on what Gurdip has here, she is taking decisions based on only the historic movements of share prices, right? So nothing else but the historic movements. So that is basically inefficient. Okay, it is an inefficient market, not efficient at all. So you will have to basically match these two together. And if you look at Oliver, he believes that share prices reflect all relevant information at all times. So all information, whether it is private, whether it is public, it is reflected. So this is an example of strong form efficient. Okay. So that's what that question is about. Okay. What do you think is the answer for question 4? Capital structure theory. If you don't know the theory, in your exam, honestly, take a guess. Okay, because this is you have 4 options, so don't leave anything blank. Okay. They're asking for the correct statement. A. Okay. Right. So before I start deciding what the answer is, let me just go to all of these theories quickly. Okay. Because there is a good chance that they can ask you to explain this in words in section C. Okay. So what is this area about? Okay. It's like this. Now you have to understand, if you're a business, you have to decide how much of debt you can have and how much of equity you can have. Because when it comes to your finance, okay, there are only 2 ways you can raise finance. Either you can go for debt or you can go for equity. Okay. Now it is understood, or it is known, if you have experience in this area, you will know that usually debt is cheaper than equity. And why is that the case? The reason for that is because when it comes to equity, we have to give shareholders a return in the form of dividends. That is one thing. Plus, they even get voting rights. Okay. So not only are we, giving them a part of our profit, that is even fine. We are even giving them a part of our ownership. So obviously that is more costly than when you compare it with just a bank loan. Because if you go to the bank and take a loan, at most what you have to do is you have to pay them an interest until you pay back the principal. Okay. So traditionally it is understood that debt is cheaper than equity. Okay. But the problem is, just because of that, we can't only have debt in the organization. We can't be running an organization 100% on debt, because then what will happen? If you become very heavily in debt, the bank is going to start thinking, okay, do we have to give this person even more if he asks? because then the bank will start having questions. Will this company be able to pay our interest on time? Okay, so those kind of issues will arise. So when it comes to this capital structure, there are many views that, people tend to take. Okay, the first one is called the traditional view. Okay, so in the traditional view, this is what we believe. So this is the graph, right? So I'll explain this graph. So we believe that cost of debt, which is KD, one second. Yeah. This KD, cost of debt, we believe, yes, it is lower than the cost of equity. Okay, usually that's the case. That part is fine. And what happens as the gearing increases, meaning we start taking more and more debt, it will be constant. The cost of debt will be constant to a very great extent. But after one point, it will start increasing. What is this point? The point where the banks feel, okay, it's going to be risky giving this particular company more and more money. So what they do, even if they give you money, they will make sure that they charge a higher interest rate, because only then they will be able to compensate for the extra risk that they are taking. Okay, so that is what the traditional view thinks about the cost of debt. We think, okay, this is how the cost of debt will move. Okay, then with regard to the cost of equity, meaning the return that we have to give the shareholders, we believe that as the gearing increases, as your debt increases, the cost of equity will also keep on increasing. Why is that? Because as debt increases, the company becomes more and more risky. Okay, so if the company is going to become more and more risky, then to compensate for the additional risk, the shareholders, they will ask for a higher return. So that's why we see that the cost of equity is actually increasing. Okay, so then when we put them both together, the cost of debt and the cost of equity, we get a line called the weighted average cost of capital. Okay, so what we can see is at a particular point of gearing, okay, that may be 50% gearing, 60% gearing, at some particular point, the weighted average cost of capital is at the minimum. So meaning maybe you're taking 60% debt, 40% equity, or 70% debt, 40% equity. That exact point we don't know, but you have to find that out through trial and error. And at that point, when you calculate the weighted average cost of capital, you will notice that it is at its minimum. Okay, so according to the traditional theory, we say that we should somehow try to find this point, this X. How do we find it? There is no equation as such. We have to find it through trial and error. Okay, we have to take 10% debt, 20%, 30%, 40%, and then find out at which point does the weighted average cost of capital come to the lowest point. Okay, so this is what the traditional theory talks about. Okay. Then we have another theory called the Modigliani and Miller theory. They came up with two theories. One was without taxation and one with taxation, right? So without taxation, what they said is, they are saying the cost of debt, it will remain the same. Okay, it's not going to increase. But what they're saying is, when the gearing keeps on increasing, cost of equity, right? Now the equity investors, they say they are also rational people. Okay, so when the debt increases, the cost of equity will also keep on increasing, because they also understand the fact that as the gearing increases, the risk increases. Okay, so then what happens, although we are taking more and more debt, okay, and although debt is actually cheaper than equity, the increase in the cost of equity will exactly set off the whatever savings you're making because of cheap debt. And ultimately, the WACC, it actually remains constant. Okay, so that with taxation, what they're saying is cost of debt, yes, it is cheaper. We know debt is cheaper. But just because of that, we can't keep on taking debt, because equity holders also rational, meaning they also have sense. So the moment they see that you're taking a lot of debt, they will start increasing their cost of equity. They will start demanding a higher return. So what happens, that extra that they're demanding, that will offset whatever savings you're making because of the fact that you're increasing your debt. So overall, the WACC is unchanged. It just remains flat. Okay. So that is the theory without taxation. Okay. Then they came up with another theory with tax. Okay. So here what are they saying? They're saying cost of debt is constant, yes, but when you take a bank loan, you will pay interest, right? So whenever you're paying interest, there is a tax savings component involved. Why is that the case? Because unlike dividend, dividend is deducted after tax, whereas interest is deducted before tax. So if you have additional interest, it's an extra expense, and extra expense means it will result in your profits decreasing. If profit decreases, what will happen? You will end up paying lesser tax. Okay. So if you take more and more debt, first thing you benefit because it is cheaper. Second thing you benefit because you are paying less tax. Okay. So what are they saying? They are saying if you keep on increasing your debt in the company's capital structure, cost of equity increases, yes, but the benefit that you get because of cheaper debt as well as tax savings, that will be more than the increase in the cost of equity. So that is why the WACC keeps on decreasing. Okay, so according to this theory, they are saying you have to run your company with 99.9% gearing, meaning almost close to 100% of your company should be running on debt because we believe that it is cheaper. Okay, so those are the three main capital structure theories. Okay, they can ask you to explain any of them with about 5-6 marks, and actually it's when you see that, you should be happy because it's an area where everything is already given in the whatever material you're using to learn. Okay. Then there is a last theory called the pecking order theory. What this tries to say is, if you're a business, we don't have to think too much about capital structure or anything, right? Just think rationally. They're saying you're a business. You want funds. Where will you go first? Okay. First place you will go is your retained earnings, your internally generated funds, because if you have the funds in your retained earnings, you can just use it, right? You don't have to pay anybody anything. There is no issue costs. There are no external parties involved. It's the easiest place to get funds. So we say, according to pecking order theory, the first place that you will go for is your retained earnings. The next place that we go for is debt. We'll try to go for a bank loan. Okay. The reason for that is when it comes to debt, it is not very public. Okay. Because compare that with equity. Everybody in the stock market will know, okay, this company is issuing new shares. There's a lot of issue costs involved. Whereas when it comes to debt, it's between you and the bank most of the time. Okay. So it's between the two of you. Nobody will know that you took the debt. And so with regard to, the amount of hassle that you have to go through, it's much less. So if you're able to go for debt, then according to pecking order theory, that should be your second option. Now, even if you can't get the debt, like say the bank refuses or something happens like that, then you go for the third option, which is a new issue of equity. Okay. But again, it comes with its problems because firstly, it is public. And most of the time, when an established company, when they start issuing new shares, it tends to send a signal saying that the company is not doing well. It may not be the case, but most of the time we make that assumption. So that is not good. Okay. And finally, it has expensive issue costs. You will have to pay the broker. You will have to, with regard to the paperwork, you will have to pay a lot. So it's not, the cheapest option that you have. But if there is no other option, then fine, you can go for equity. Okay. So that's the pecking order theory. Now, believe me, I have seen questions where they even ask you to explain these 4 theories, and they have even given you like 8 to 10 marks just for that. Okay, so make sure you have the points in mind in case you have a written question. Okay. Right. So what is this question saying? Which of the following statements concerning capital structure theory is correct? In the traditional view, there is a linear relationship between the cost of equity and financial risk. Okay, so financial risk means it's your debt. How much of debt you have, debt equity structure. So when it comes to the cost of equity, I'll show you that graph. They're saying it's a linear relationship. It's not a linear relationship. You can see very clearly it's a curve. Okay, so A can't be the answer. Then it's saying Modigliani and Miller said, in the absence of tax, the cost of equity would remain constant. Absence of tax, cost of equity is not constant. It keeps on increasing. Okay, so that is also wrong. Pecking order theory indicates that preference shares are preferred to convertible debt as a source of finance. So they're saying, according to pecking order theory, we will give preference to a share equity as opposed to a debt, which is wrong. First, we give preference to retained earnings, then we give preference to debt, then we give preference to shares. Okay, so C is also wrong. Business risk is assumed to be constant as the capital structure changes. Now, actually, through elimination, you know this should be the answer. But let me explain business risk and financial risk also. Okay. So when it comes to risk, there are two types of risk. What's business risk, right? Now, let's say, for example, you are a business where you make umbrellas. You're making umbrellas, that's your business. Now, you have one major risk, and that is the fact that it won't rain, because not a lot of people use umbrellas when it's sunny, right? So if there is no rain, obviously there is a good chance that your sales will actually see a drop. So that's a business risk. Okay, you have to figure out a way to reduce this risk. Maybe you can go and invest in another business where maybe you're making sunglasses or something. So what will happen in periods of sunshine where umbrellas are not doing well, sunglasses will do well. And in periods of rain, when sunglasses might not do well, umbrellas will do well. So when it comes to business risk, this is a risk that you're facing due to the nature of your business. Okay, so that is something that has nothing to do with your debt and equity structure. Okay, but when you think about financial risk, simply what we're saying is the risk that you will have to face because of your debt equity structure. For example, if you have too much of debt, heavily in debt, there is a good chance that if you are not able to pay your interest, the bank might force you to liquidate. Okay, if you are in heavy debt. So that kind of risk is called a financial risk. Okay, so here they're saying business risk is assumed to be constant as the capital structure changes. That's true, because when the capital structure changes, your debt equity ratio changes, your financial risk will change. But it will not disturb the business risk. Business risk is completely different. Okay, so there the answer will be D. Question 5 is saying, which of the following actions is least likely to increase shareholder wealth? What do you think? Sorry. Okay, so let me go through it. Again, this is an example of a situation where you may not be very clear with the answer, right? So in that case, the best thing is to go for elimination, meaning remove the obviously wrong answers. Okay. So which of the following actions is least likely to increase shareholder wealth? So which of them will not cause an increase in shareholder wealth? The first one is saying the weighted average cost of capital is decreased by a recent financing decision. Now, if you reduce your weighted average cost of capital, that's like your interest. Just think of it like an interest rate. Okay. So if that has reduced, that means that will actually boost your profits. Okay. It will boost your cash flows because an expense is reducing. So in the long run, that will result in an increase in shareholder wealth. Because for example, meaning the amount of interest that you're paying to the bank is reduced for some reason. Okay. The financial rewards of directors are linked to increasing earnings per share. Okay. Seems to be the answer, but I'll explain that in a bit. Let's see C and D. The board of directors decide to invest in a project with a positive NPV. If you invest in a project with positive NPV, definitely it will increase your shareholder wealth because you will start earning profits. Okay, so that is definitely not an answer. The annual report declares full compliance with the corporate governance code. Okay, so what's this corporate governance code? It's like a code of good practice. Okay, so I don't want to go into that in detail. You can have a quick read through. But corporate governance, we actually look at it in another paper called BT, if you're familiar. It's basically where we make sure that any kind of fraud doesn't happen within the organization. Okay, so these are a series of steps that an organization can take to make sure that any fraudulent activity doesn't take place. So if the annual report now, and this corporate governance code, it's not compulsory. If you want, you can follow it. If not, it's fine, right? So if the annual report is declaring full compliance, that's a very good sign because it means that nobody can play within the organization, and definitely that will result in benefit to the shareholder. Their shareholder wealth will increase. Okay, so D also will increase shareholder wealth. So based on elimination itself, I can see that the answer is B. So what are they saying there? They're saying we are giving directors financial rewards, linking it to an increasing earnings per share. So if you're going to give your directors a bonus based on the earnings figure, what will they do? They will make sure that they keep this earnings figure as high as possible. So even if there is a positive NPV project, they might not invest in it because then what will happen? The earnings will drop. If earnings drop, that means their reward will reduce. So if you're going to link the director's bonus with something to do with earnings, there is a chance that they will take decisions that are against the shareholders. Okay, so B will be the answer. Which two of the following statements are features of money market instruments? Which two of the following statements are features of money market instruments? What do you think? If you're not familiar with the money market and all that, please go through that theory area, okay? Where we talk about the capital markets, the money markets. So two of the following statements, which are features of money markets. Okay, so I'll just read through it. A negotiable instrument can be sold before maturity. Actually, that is true. When it comes to the money market, it is like a second-hand market. Okay, so anybody can sell any instrument that they have. So if it is a derivative, if it is a future, whatever it is, we don't have to wait until the maturity date. You can sell it any day before also. So the first one is correct. The yield on commercial papers is usually lower than that on treasury bills, right? So what's a treasury bill? Usually if the government requires funding for some reason, then what they do is they tend to issue something called a treasury bill. Okay, so anybody can purchase a treasury bill and they lend their money to the government. In return, they get this treasury bill. So what happens? The government, see, when it comes to lending to a normal person and lending to the government, definitely lending to the government is less risky. because it's highly unlikely that they will default on interest payments and they will default on paying back the principal. It's the government end of the day, right? So because of that, the treasury bill, okay, since it is something that we are giving the government, we tend to perceive it as low risk. Okay, so because it is very, I mean, in terms of the risk, it's not much. They don't pay a high interest as well. So the low interest rate is also paid when it comes to a treasury bill. Why do they pay low interest rate? Because the person who is giving the government money, he doesn't have to face too much of a risk. Okay, so then they're saying here the yield on a commercial paper is usually lower than that on treasury bills. That's wrong, because a commercial paper is something that a company will issue. If they want debt, they will issue a commercial paper. When it comes to a company, the risk is much higher. Okay, so when it comes to a commercial paper, the risk is high. Okay, so because the risk is high, the interest rate that they will have to offer will also be higher. Okay, so the lowest interest rate for a debt instrument will usually be for that of treasury bills. So that is actually wrong. Discount instruments trade at less than face value. That's true. The reason why we call it discount instruments is in the market, it is sold for less than their nominal value. Commercial paper is often used by companies to fund long-term expenditure. That's wrong. Commercial paper is usually used to fund short-term expenditure. Okay, so I'll just give you a quick recap here. When it comes to debt, you can either go for a non-tradable debt, right? So I'll explain this way. You have tradable debt and non-tradable debt. Tradable. Okay. Non-tradable debt is what we always talk about, the bank loan. Because if you take a bank loan, you can't trade that with somebody else. No, you can't sell that loan to somebody else. Okay. That is non-tradable. Tradable means once you take the debt, once you take the money, what you can do is, if you want, you can trade that particular debt with other people. Okay. So when it comes to tradable debt, we have different types of instruments. One is called a commercial paper. Other is called a debenture. And the third is called a bond. Bond is the one that you might be very familiar with. Okay, so there's nothing different, right? The only difference between them is the time span. Okay, so if you want debt for a short period, short-term debt, you usually issue a commercial paper, less than 1 year. If you want a medium-term debt, then you will go for a debenture. If you want a long-term debt, you will go for a bond. Okay, so they're just different names that you have to be familiar with. I know that since we don't use tradable instruments in the country, you might have an issue trying to understand what it means, but don't worry too much about it, right? It's basically a small theory. When you go through, the study text or any area where they explain this, it should make sense to you. Okay. So here the answer will be A and C. Okay, so you can see here, the second question was a calculation, right? After that, 1, 2, 3, 4 questions, meaning 8 marks, completely based on theory. Okay. Now we get a calculation. So some people ask, what do you think is the best order to do the paper? Best order to do the paper is the order that the examiner gives you. Okay, because it is designed in such a way that you won't get too tired. Okay, because if you try to do all the calculations at the same time or all the theory at the same time, you will get tired, right? So that is why we mix it this way in the exam. Right, so it says here, the following extracts are from the statement of profit or loss for Goha Company. They're giving you the sales, cost of sales, profit before interest and tax, interest, profit before tax, tax and profit after tax. 60% of the cost of sales is variable costs. What is the operational gearing of Goha Company? What do you think? See? Okay. Right. So usually we are so used to this equation, right? When we want to calculate gearing. Okay, we are used to this equation, debt over equity, or we even use debt over equity plus debt. Okay, but in this situation, we don't have any of that information. Okay, so now we have to think of another equation where we can calculate this operational gearing. Okay, so operational gearing, there is another equation, and that is your contribution divided by your profit before interest and tax. Okay, so if you look at this question, we can kind of find out contribution. It's not given directly. PBIT is given, profit before interest and tax, very clearly given there, 10,000. Okay. So contribution, you should remember this. Contribution equals to selling price minus variable cost. That is only contribution. Okay. So here we have the sales income. We have the cost of sales. Now the thing is here they're saying 60% of cost of sales is variable cost. So if you can get that 60% and if you deduct it from 60,000, we have our contribution. Okay. So let's get 60% of 50,000. That is 30,000. So this is your variable cost. Okay. So if I want contribution, that's just going to be the selling price, which is 60,000. Minus the variable cost, which is 30,000. So that will give you an answer of 30,000 divided by the profit before interest and tax, which is 10,000. Okay. So 30,000 divided by 10,000. Yes, correct. The answer is D, 3 times. So question 8 is a very classic working capital management question. Okay. So let me see. Yeah, we'll finish this off and take a quick, maybe 15 minutes break so we can pray and come back. Okay. So let's do question 8 and take a break. How do you think you should do this? Now, if you get working capital management as a question, even in section C, this particular question is a very viable question. They can ask you this. Okay. I'll give you 5 minutes. It's a cost versus benefit analysis. Okay. Just to give you a heads up of what it is. See if you can get the answer. You got the answer as 17,095.89. Okay, we'll see. Okay. Right. So this is an example of a cost versus benefit analysis. Okay. So we do this a lot when it comes to working capital management. Okay. So it's saying here, the management of Lamara company has annual credit sales of 20 million and accounts receivable of 4 million. Okay. Working capital is financed by an overdraft at 12% interest per year. Assume 365 days in a year. So they're asking you to calculate the annual finance cost savings if the management reduces the collection period to 60 days to the nearest dollar. Okay. So they're saying a situation like this, right? Right now, we don't know what our receivable days are. Okay. We can calculate it because we have the sales, we have the receivables. So we can find the receivable days. Whatever that answer is most probably more than 60. Okay. So what is the management saying? If we reduce the collection period to 60 days, will there be a finance cost savings? So why will there be a finance cost savings when the receivable days decrease? Because when your customers pay you quickly, okay, then what happens? That receivable amount you get you get it to your hand faster, right? So you won't have to basically take a loan until the customer pays because the customer has paid early. Suppose the customer pays late, then still we need the money for our working capital. So for that period of time, we will have to take an overdraft or something and pay a 12% interest until the customer pays the amount. Okay. So the question is asking you, if they pay a little early in 60 days, what will be the finance cost savings? Okay. So first let's figure out what is the current receivable days. Okay. So how do we calculate this? Receivables over sales. Yeah. Receivables over sales into 365. Yeah, I'll just put it this way in case somebody wants the equation, right? Into 365. So this is the equation you will use to calculate the receivable days. Okay. Right. So let me just write down the receivables over here. That was how much? 4 million. And the sales was 20 million. Okay, so I'll just write it down. So if I want the current receivable days, then it's going to be 4 divided by 20 into 365. Okay, so okay, so my current receivable days is 73. Okay, it's 73 days. Okay. Now, what am I going to do? I am going to reduce the receivable days to 60 days. I'm going to maybe give them a discount or even maybe force them do something. Make sure that they don't take 73 days and they take only 60 days. Okay, so how many days reduction are we talking about? So reduction in receivable days, that is, we're talking about 73 minus 60, 13 days. So they are going to pay me 13 days in advance. Okay. So if the receivable days are reducing by 13 days, using this same equation, we can find out how much is the receivables reducing by. Okay. So what I'm trying to say here is, I'll put in the figures here. I'm saying that the receivable days are reducing by 13. What I mean by that is I can find out by how much the receivables are reducing as well. So receivables divided by sales, which is 20 into 365. Okay. So when you rearrange that equation, you will find out that the reduction in receivables, okay, the reduction in receivables, I'm sure you know how to do it. Basically, 13 divided by 365 into 20. Okay, I'm rearranging the equation to find the receivables. So reduction in receivables, that will be 712,329. Okay, that's the reduction in receivables. So if you want, instead of putting receivables here, you can put it as reduction in receivables. Okay, so if reduction in receivables has happened, what that means is 712,329 worth of your receivables you get beforehand itself, you get early. So if you get this 712,329 early, you will not have to finance that with an overdraft, meaning you will save 12% of interest on this 712,329. Okay, so reduction in interest, that will be 712,329 into 12%. Okay, so that we're talking about at your exam, you can just leave formulas on, okay, because your examiner can have a look. But if you're not comfortable, then you can put the equation and then do the formula in the next cell. Okay. The reason why I'm putting the formula is there will be someone who watches this video later. They might be wondering from where that 85,479. That will actually be 85,479. Okay. So they're saying to the nearest dollar, you can ignore the 0.5. Clear? Any questions here? Let me see what you've done here. Okay, so the 73 days is there. 4,000 into 12%. I can't understand what you've done here, Step. But do you get what I did? Okay. Because actually, if you learn this from the study text, what we have there, I know, is a little that like what can be done in one step, they tend to do it in 2 to 3 steps, right? They don't take a reduction in the receivable days. They try to do everything, the straight way. But I feel this method is a lot easier. It will work for all the questions. You won't have to think too much at your exam. You just do it in this order and, everything will fall into place. Okay. Right. So I think it's already late, 7:21. Let's take a quick break. We'll come back at 7:35 and we'll continue. Okay. Okay, hope you're back. We can try out question 9. Okay, saying identify by clicking on the relevant box whether each of the following statements concerning financial management is true or false. It's an easy question. What do you think? True, 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 false. Okay, good. So first one is saying it is concerned with investment decisions, financing decision, dividend decisions. Those are the three decisions of financial manager. That's true. It's concerned with financial planning and financial control. That's also true. It considers the management of risk. Yes, we have different chapters itself for risk management. That's true. It's concerned with providing information about past plans and decisions. That is false. Financial management, we are concerned about the future. Okay. We don't care too much about past information. So that is false. Scava company has paid the following dividends per share in the recent years. So 2014, 13, 12, and 11, they have different dividends that they have paid. The dividend for 2014 has just been paid and Scava company has a cost of equity of 12%. Using the geometric average historical growth rate and the dividend growth model, what is the market price of a Scava company share on an ex-dividend basis? They're asking for the market price of the share. How will you get the answer? They're telling you the model also. They're saying use dividend growth model. Have a go and see. This is a very important area, okay, because this is just not to do with calculating the market value. It's not just market value. This is actually the calculation of cost of equity also. The equation is the same. In this question, they're giving you cost of equity, asking for market value. In another question, they can give you the market value and ask you to calculate cost of equity. Okay, so I have a feeling you might be stuck. So I will go through the theory once properly, and then okay. Right. So I'll go through the theory once, and then we will try it out. Okay. So this is actually under the chapter cost of capital. This is again, like I said, a very important area. So I'll just go through a summary. Okay. Now it's like this. If you have sources of finance, now if you want finance in your company, you can either go for equity or you can go for debt. Okay. So if you're going for equity, you will have to pay those shareholders a return. Okay. That return, the percentage that you're going to pay them back in the form of dividend, that is only the cost of equity, because if you take money from them, you will have to give them some return. That is only the cost of that money that you take. Okay, right. Okay. Then it's good, because then you will have a brief idea of what you're going to go through. Okay, it's fine. I'll go through it. So it's like this, right? So the cost of equity is basically the amount that you will have to pay your shareholders, or the return that they are expecting from you. Okay. And if you're going for debt, there can be different types of debt. The only debt that you might be familiar with is a bank loan. But in addition to that, you can even issue a bond, you can issue a commercial paper, all of them fall under debt. But one thing is common, and that is, like how you have to pay something to the shareholder, even the debt holder will ask for a return. And his return has a special name again called interest. Okay. So the cost of debt is basically the interest that you will have to pay. So if I want to know, okay, when it comes to my company and I'm talking about capital, I'm talking about equity plus debt, right? So if I want to know, okay, what is the cost of capital, meaning including equity and debt, cost of equity plus cost of debt. If I want to know what's the cost of capital, I have to calculate something called the weighted average cost of capital. Okay, so to calculate this weighted average cost of capital, first I have to have the cost of equity and I should have the cost of debt. Okay, so how do I calculate cost of equity? There are many methods that you can follow. Okay, so let me go to the summary. Okay, so cost of equity, if it is an ordinary share, there are three different methods that I can follow. If it's a preference share, there is only one method. Okay, so what is this three methods? The first one is the dividend valuation model, or what they call here the dividend growth model. Both are the same. Okay, so this is where we have an equation. We say that the market price of a share, that's P naught, that should equal to the current dividend multiplied by 1 plus the growth rate of the dividend. Okay, so if your dividend is growing by say 3% or 4%, that rate, the growth rate divided by RE is basically the cost of equity minus again the growth rate. So if by chance the question is asking you to calculate the cost of equity, then you need all of this information. So what is the information that you need? You will need the market price of a share, that's P naught. You will need the dividend information. You will need the growth of the dividend. And if you have all of this, you can find KE. Okay, that is one situation where you want to find the cost of equity. But you can have another situation also. And what is that situation? Where you want to find the market price per share. In that case, again, same equation you can use, but instead of P naught being given, they will give you KE. Okay, because then, like in this question, you can see they gave you the cost of equity and they are asking you for the market price per share. So this dividend valuation model, it can be used to calculate two things. One is the cost of equity or even the market value of a share. Okay. So the next thing is, in this dividend valuation model, we have this G, right? This growth rate. There are two ways you can calculate growth. One is using this extrapolating past dividends method. So here we have an equation. D naught, which is your current dividend, divided by dividend n years ago. N years means either 3 years or 4 years, whatever data you have, to the power 1 over n minus 1. N is the number of years. So if you have past dividends, like in this question, then you can calculate the growth rate using this equation. Suppose you don't have that information, you have to use a second equation. We call it Gordon's growth model. Okay, so here G equals to your accounting rate of return. Usually that should be given to you into what we call a retention rate. Okay, we call it a retention rate, meaning what percentage of your profits you're retaining within the organization. So usually this retention rate and even the ARR, everything will be given in the question. So since I haven't given a breakdown, I'll show you this as well. Yeah. So RE is the accounting rate of return or the return on equity, and B is the earnings retention rate. So usually it should be given in the question. Suppose they give you the payout rate, then you have to take 1 minus the payout rate to get to the retention rate. Suppose the payout rate is also not given, it can be calculated using dividend per share over EPS into 100%. So what is this retention? Like I said, if you make a profit, how much of the profit you're reinvesting into the business and how much of it are you paying to your shareholders? Okay, so the retention rate is how much you are reinvesting into the business, because we believe the more you reinvest, the more the company will grow. So that is why we are including the retention rate to calculate growth. Okay, so that is one method. That's just one method of calculating either cost of equity or the market price per share. Okay. Then when it comes to only cost of equity, there is another method that you can use. We call it the capital asset pricing model, CAPM. Okay. So there you have an equation where the cost of equity equals to the risk-free rate. Risk-free rate means the interest rate that the government is paying on treasury bills. Okay, the interest rate that the government is paying on treasury bills, because that is the risk-free rate, right? We assume that when it comes to a government treasury bill, the risk is very low. Okay, that plus beta, I'll explain beta in another place, multiplied by the RM minus RF means the return in the market. Okay, so risk-free rate is for a treasury bill. RM is in a normal, business scenario, the return that we usually get for a normal investment. So RM minus RF. Okay, so what is this beta? Beta is basically a measure to incorporate risk into the calculation. Okay, so what is the type of risk that we're trying to incorporate? We try to incorporate systematic risk. Okay, we try to incorporate systematic risk. So I can't go into great detail here. You will have to have a look at this particular area. But here I'm just showing you the equations that you can use with regard to calculating KE. Okay. And the third method that you can use is using something called proxy betas. Proxy beta means when you don't have the beta of your company, you can use the beta of one of your competitors. But you can't use it directly. You will have to make certain adjustments. Okay. So what you have to do, you will have to do something called a de-gearing, a re-gearing, and then you will be able to use it in the CAPM equation. Okay, so when somewhere down the TRG, not today probably, but somewhere down the line, we will go through CAPM in detail. For now, we will be focusing on this dividend valuation model. Okay. Then if you have a preference share, the cost of the preference share will equal to the dividend divided by the market price of the preference share. It's the same equation. It's just rearranged to make cost of preference share the subject of the formula. Okay. And we don't incorporate growth usually when we are talking about preference shares. So this is the only equations that you have to know with regard to how to calculate cost of equity. Okay, I'll go through cost of debt as well because we will have to do another question with regard to cost of debt, right? So when it comes to cost of debt, it's not always straightforward. If it is non-traded, if it was a bank loan, it is straightforward because cost of debt is just the interest rate. It's just the interest rate. And if you want to remove the impact of tax, if you want the cost of debt minus the tax benefit, it will be the interest rate times 1 minus t. That's also easy, right? But if it is an irredeemable debt, a redeemable debt, or a convertible debt, then the calculations change. So if it is irredeemable means what? Once the company issues that debt, okay, once they issue that debt, they will keep on paying the interest, but they won't really pay back the principal. Okay, so every year they will pay back 10%, 12%, whatever the interest is, but they won't pay back the principal to the person who gave them the money. That is irredeemable debt. So if I want to get cost of debt for irredeemable debts, it will be the interest over the market value of the debt. Okay, and if I want to incorporate the tax into the situation, then it will be KD 1 minus T into the interest times 1 minus T over market value. Okay. Then there is another type of debt called redeemable debt. Here what happens? Maybe for 5 years, I will pay interest. On the 5th year, I will pay interest as well as repay the entire principal amount. So it's redeemable. Okay. So suppose you redeem at par or at a premium. Okay, so at par means I'm redeeming it at $100. When it comes to debt instruments, we believe that the nominal value is going to be $100. Okay, so if I'm going to redeem it at $100 per bond or per commercial paper or per debenture, or if I'm redeeming it at a rate more than that, at a premium, then to get the cost of debt, I have to do an equation similar to an IRR, which we will do today. Okay, but suppose we are redeeming it at the market price. Okay, suppose we are redeeming it at the market price, then the position is the same as irredeemable debt. So in that case, we will have to use these two equations to calculate the cost of debt. Okay, then there is another type of debt called a convertible. Okay, actually, I know this is a lot of information. We usually take about 2-3 classes even to go through this. I'm trying to put everything together in one slide, right? So even if you get about 20 to 30% of what I'm trying to say, it's fine because then when you go through the information in the slides one by one, it will make sense, right? So when it comes to a convertible, it's like this. Either I can convert it into, when I'm doing the redemption, I can either give them cash. The person who bought or gave me the debt, I can give him cash, or I can give him shares in the company. Okay, so whichever one is higher, ideally, we will go for that option. Okay, so it says here, choose the highest, the cash option or the share option, and use either the redemption value or conversion value in the IRR calculation, because obviously the debt holder will choose whichever one will give him a higher return. Okay, so we will actually go through some of these cost of debts also today, hopefully if we have time. But for now, let's focus just on the dividend valuation model. So all that you need for this question is this equation, and this. Okay, so I'll copy it down here. So this is the dividend valuation model equation, and this is the growth. So using just these two equations, you should be able to calculate the market price of this Kava company. Okay. Okay. Right. So let me start off. If you want to get P naught, market value, first of all, you need growth. RE is cost of equity. Cost of equity, you can call it KE or RE. Both are the same. We use it interchangeably. Rate of equity, yes. Don't ask me why we say KE, although cost starts with C. I also don't know. It's just K. Okay. I prefer to use K because R is a term that we use everywhere. Like, for example, even in present value, it's say 1 over 1 plus R to the power n. Then that R is the interest rate. So here we don't want to get confused putting a simple R. Better to use K. We don't use K anywhere else in the syllabus except for cost of equity, cost of debt. Okay. So if I want to use the equation, the dividend valuation model, right? So this is the dividend valuation model equation. If I want to use this, first of all, I need to get the growth rate, which I don't have. I will have to use this extrapolating of past dividends to get the growth rate. So let's do that first. So D naught means the current dividend. Okay. So the latest year that we have is 2014. So the current dividend, you can consider it to be 0.360 divided by the dividend n years ago. So we have the oldest dividend that we have is from 1, 2, 3, 4 years ago. No, not 4 years, wait, 1, 2, 3 years ago. Okay, so that will be 0.311. Okay, so that will be to the power 1 over n. The number of years we have is 3 minus 1. That's how you get the growth rate. So some lot of students make a get confused with the n figure. Remember, always take the gaps. Don't take the number of figures that you have. Take the gaps. So if you're in, for example, think about it. If you're in 2014, 2011 is not 4 years ago, no. 2010 is only 4 years ago. So 2011 means we're talking about 3 years ago. Okay. So you can put this in your cal and you should get the growth rate as 5%. Okay, so the growth rate is 5%. So now we have everything that we need to calculate this P naught, which is the market value. So there is a lag like this. Just give me a minute. Let's hope that fixes it. Yeah. So P naught equals to D naught, which is the current dividend. We have that 0.360 times 1 plus G, which is 5%, divided by RE. Now this RE, they gave it to me, cost of equity, which is 12%, minus G, which is 5%. Okay. So you can put that as it is in your calculator and you can get P naught, which is 5.40, which is answer C. Okay. So that's how you get the market value using the dividend valuation model, right? Now get this clear, right? The slide I showed you, it was talking about different ways to get cost of equity, right? So there are different ways to get market value. One of them is the dividend valuation model. There are other methods as well to get market value that you will see in another chapter called business valuation. Okay, so you have the PE ratio, you will have the earnings method. There are different methods. One of them is this dividend growth model method. Okay. So you have to summarize this. Okay, if you don't summarize this, it will be too much of information. You won't know where to go for what. Okay, so in my slides, I have it summarized. So like how the cost of capital is summarized. I'm not sure about the chapter number. One of the last few chapters, business valuation also will be summarized. Okay. Right. There is a risk, question 11. There is a risk that the value of our foreign currency denominated assets and liabilities will change when we prepare our accounts. So somebody is saying that. So they're saying there is a risk that our foreign currency denominated assets. So we are having certain assets that are denominated in a foreign currency. They're saying when we prepare our accounts, there is a chance that those values can change. What is the risk that they're referring to? Is it translation? Is it economic? Is it transaction? Or is it an interest rate risk? Very good. Yes, translation, right? So when it comes to risk management, we learn this. There are different types of risks. And if it is to do with a subsidiary or a parent converting the subsidiary's accounts into their parent's currency, then the risk that we're talking about is a translation risk. So 11 is done. You can try out 12. They're asking you to calculate the length of the working capital cycle. So this is again working capital management. It's an easy question actually. Yes. So I'll just go through it since we brought it up, right? So transaction risk means it's the fact that, let's say you are maybe an exporter, you're exporting something from the country and you give your customer who is abroad a particular price. Okay, now the problem is, let's say you quote the price today and the actual transaction, it happens only 1 month later. Because this is a foreign transaction, it will take at least 3 weeks to a month. So what happens in that period, the exchange rate has changed. Okay, so you thought you will get maybe 20,000 rupees and you quoted that particular equivalent dollar rate. But when the money actually came to you, you didn't get 20,000 because the exchange rate changed. That's transaction risk. Economic risk is actually the long-term version of transaction risk. Okay, so especially now, if you're an exporter, you will have to face this time and time again and again, you will have this problem. So it's a long-term version of transaction. Translation risk is because of the fact that your subsidiary is a foreign subsidiary, and when you're doing the consolidation of your statements, you will have to convert it to your parent currency. During that conversion, there might be a change in your values. Okay, again, depending on the exchange rate. So that is the translation risk. Right. They're asking for the length of the working capital cycle. What's that? What do you think it is? Okay, good. So working capital means we should all be familiar with it. Working capital is basically your current assets minus your current liabilities. Okay, that is only the basic concept of working capital. So here, basically add up all your asset figures and deduct the liability. So if you take receivables, that's an asset. Raw material inventory is an asset. Work in progress inventory is an asset. So 52 plus 42 plus 30. Trade payables is a liability. So that has to be deducted, minus 66. And finished goods inventory again is an asset. So you will have to add 45. So we are talking about 52 plus 42 plus 30 minus 66 plus 45, which is, yes, 103 days. That's the working capital cycle. Which of the following are usually seen as benefits of financial intermediations? Financial intermediation means basically like having a bank. What's the benefit of having somebody in between the borrower and the lender? Why can't they just do a transaction directly? Why do we like to have somebody like a bank in the middle? What do you think is the answer? D, 1, 2, and 3. Okay. So if you take a bank, can you fix an interest rate in the bank? I mean, if you have a fixed interest rate, yes, but we don't have control over that, right? That is up to the bank. We can choose whether we want a floating rate or a fixed rate, but what rate they fix for you at the beginning, that is up to them, right? Whereas if you're going to directly talk to the lender, he says, give me 10% interest. You can say, please reduce, make it 8%. Okay, then after that, a few months later, you can again try to make a negotiation. Can we make it 7%? Yeah, we have a say in the interest rate. Whereas in the bank, it's their policy. Fixed rate means they will say 10%, you take it or you leave it. Floating rate means depending on the interest rate on that particular month, you will have to pay, right? So when it comes to financial intermediation, we don't have this benefit. We can't fix the interest rate. Okay. Risk pooling, yes, it's there. Risk pooling means it's like this. Now, let's say I have $100,000. If I go and give that 100,000 to one person, okay, and that person defaults, like he goes bankrupt or something, I will end up losing my entire 100,000, unfortunately. But if I go and put it in the bank, my 100,000, it will be split into different people, right? So even if one person defaults, it's not going to affect the lender. Okay, because the bank will make sure that they have, even given an allowance for this default also to happen. So in terms of risk, yes, it's reduced when it comes to a bank. Maturity transformation is to do with the timing. It's like if I want to give my money only for 1 year, whereas somebody else wants it for 2 years, the borrower wants it for 2 years, there is no mismatch. There won't be a problem because of the fact that we have pooled the funds. So if I want, I can take it back in 1 year. He can give it back in 2 years. Since a lot of people have put money in the bank, it shouldn't affect anybody. Okay. So the answers will be 2 and 3, which is C. Right. Which two of the following statements concerning working capital management are correct? Which two of the following concerning working capital management is correct? So of these 15 questions, only 6 were calculations. Everything else has been theory. Can you see? One and three. Okay, let's see. The twin objectives of working capital management are profitability and liquidity, correct. When it comes to working capital management, we are trying to balance profitability and liquidity. Okay, the reason is if you want to be profitable, you have to invest a lot. Okay, you can't expect to keep money in your bank account. You have to invest it somewhere, then only you will earn a return. So if you want profitability, you will have to invest. But when you invest, what happens? You don't have cash in hand. It will be fixed somewhere, it will be tied up somewhere. So what happens? Your liquidity situation, it actually becomes bad. Because only when you have money in your bank account or in your drawer or somewhere where you can access it, you are liquid. So in working capital management, what are we trying to do? We are trying to balance it. We are trying to make sure that our profitability is also acceptable. At the same time, we have enough liquid cash reserves so that we will never come to a position where we can't, pay our suppliers or pay interest or something like that. So it's always a trade-off between profitability and liquidity. So that's correct. A conservative approach to working capital management will increase profitability. Conservative means, just think of it like this, somebody who is scared to take too much of risk. Okay, so taking risk is a person who wants profitability. Okay, so if you're conservative, that means I'm scared to take risk. I don't even want profits. If I have enough money in my drawer, I'm happy because I want to have a lot of liquidity. I don't want to come to a position where I can't pay interest or something like that, right? So a conservative approach means usually they will try to have a lot of cash in hand, and as a result, their liquidity position will be good, but profitability, it will actually decrease. So here they're saying the opposite. They're saying it will increase, so it's wrong. Working capital management is a key factor in a company's long-term success. That's correct, obviously. D, the current ratio is a measure of profitability. No, current ratio is a measure of liquidity. Okay, so the answer correct, A and C. Question 15. Governments have a number of economic targets as part of their monetary policy. Which two of the following targets relate predominantly to the monetary policy? Okay, that's easy. 2 and 4, correct. Okay, so increasing tax revenue, obviously that is fiscal policy. Controlling the growth in the size of money supply, anything to do with money supply and interest rate, it's monetary policy, right? So B is an answer. Reducing public expenditure, again, fiscal policy. Keeping the interest rate low, that is monetary policy. So yes, the answer will be 2 and 4. So that's it for section A, right? So at this point, 30 marks of your question done, right? So now let's move on to MTQs. Okay, so it says here, this section of the exam contains 3 OT questions, objective test questions. Each OT case contains a scenario which relates to 5 OT questions. Yes, Ashton. Have a question? Conservative approach means they will invest less. Okay, because they don't want, it's like just think of somebody who doesn't want profit. He just wants to be in a comfortable position. So if you want to be comfortable, you have to have cash in hand. If you want to have cash in hand, you will invest less. But if you invest less, you won't have enough profitability. That's what to do. Understood? So aggressive is the opposite. Aggressive means somebody who wants profits. So what will he do? He will keep on investing. Even if he doesn't have cash in hand, he's not scared. Right? Okay. So each OT case contains a scenario which relates to 5 OT questions. So there are 3 big scenarios. Under each of them, you will have 5 smaller questions. Each question is worth 2 marks and it's compulsory, and the section is worth 30 marks in total. Okay. So, yeah. I'll give you a few minutes, go through this, and then we can try out the questions. They have a lot of instruments here. It's to do with, obviously, loan notes as well as equity. Everything to do with financial instruments. Okay. So let me also go through this and I'll show you what you need to figure out when you're reading a question, right? So it says here, car company currently has the following long-term capital structure. Okay, so we have equity. Ordinary shares worth 30 million. Reserves are 38.4, total of 68.4. Non-current liabilities, you have bank loans worth 15 million. convertible loan notes, 8% convertible loan notes. What that means is the interest that you're paying to the loan note holder is 8%. And it's convertible means after a particular period of time, you can either pay him back the entire principal as cash, or instead of that, you can give him shares in your company. Now, it's not the company's decision. The loan note holder will decide whether he wants a redemption in cash or whether he wants to take shares. So that's up to him. So that is a convertible loan note. 5% redeemable preference shares means, again, the interest rate is 5%. Redeemable means after a period of time, you will have to pay back the principal to that particular shareholder. So why are we putting a preference share under non-current liability? Although it's a share, the reason is when they are a preference shareholder, true, they are called a shareholder, but that 5%, you have to pay them. That dividend has to be paid whether you make a profit or whether you make a loss. So although we call them a shareholder, in essence, it's almost like a loan note holder only. It's like interest. Like interest, you can't default. This 5% also you can't default. So that's why we consider them also liabilities, non-current liabilities. Okay, so 15 million there. So you have a total of 70 million. Total equity and liabilities is 138.4 million. Then they're talking about these loan notes. They're saying the 8% loan notes are convertible into 8 ordinary shares per loan note in 7 years' time. So they're saying one option is whatever number of loan notes that we have, we don't have the number yet, but for every loan note that we have, we can convert it to 8 ordinary shares. When can we do this? In 7 years' time. One option. If they don't convert it, then the loan notes can be redeemed on the same future date at a nominal value of $100. So the loan note holder, he has an option. If he wants, he can take these 8 ordinary shares per loan note, or he can ask you to pay $100 per loan note. Whatever he chooses, you should be able to do as a company. Obviously, the loan note holder will choose the one that gives him the highest return. Okay, so if the shares are giving him a higher return, he will take that. If the redemption in cash is giving him the higher return, he will take that. Power company has a cost of debt of 9% per year. So that's given to you, KD. The ordinary shares of power company, so they're talking about these ordinary shares, they have a nominal value of $1 per share. The current ex-dividend share price of the company is $10.9 per share. So what is an ex-dividend share price? It means what ex-div means is excluding dividend. Okay. So usually all our questions, we have to use an ex-div share price. In this case, it's given that way, so no problem. But suppose they give you something called a cum div. Okay, meaning cumulative of dividend, then the share price you have to deduct or subtract the dividend figure to get the ex-dividend share price. Okay, so remember that whatever equation you're using, you can't use a cum div share price. You have to use the ex-div share price. Suppose you have cum div, you have to deduct the dividend for that particular year to arrive at ex-div. And share prices are expected to grow by 6% per year for the foreseeable future. The equity beta of power company is 1.2. So they are giving you the equity beta as well. Question 16. First one is asking you, the loan notes are secured on the non-current assets of power company, and the bank loan is secured by a floating charge on the current assets of the company. So the loan notes, the convertible loan notes, they are secured on the non-current assets. So suppose you don't pay the loan note holder your interest, they can claim the non-current asset. And the bank loan is secured by a floating charge on the current assets of the company. So they can claim your current assets. Okay. Arrange the following sources of finance of power company in order of the risk to the investor with the riskiest first. Okay, so if I was an investor, who of these following? Is it the loan note holder, ordinary shareholder, redeemable share, preference shareholder, or the bank loan holder? Who is at the most risk and who is at the least risk? You have to order it in that order, right? So what do you think it will be? We're talking about most risk for investor and Least risk for the investor. That's the situation. So in your exam, again, you should be able to match it, right? You should be able to take this one and put it near the loan notes if that's the answer, or one and put it to bank loan. It will be like a matching situation. Okay. So you're saying bank loan, loan notes, redeemable preference share, ordinary share. Okay. Actually, I feel you have the answer, but you have put it in the exact opposite order. Okay, so let me explain this again. Most risk for the investor. Okay, now think about the loan note holder. He at least has his loan note secured on non-current assets. Definitely, you have to pay him interest. So his principal is also secure. His interest is also secure. So he's not very risky. He's not in a risky situation. Think about the ordinary shareholder. His dividend also is not certain, and his principal is also not certain. If the company goes bankrupt, think about it, the last person you pay is the ordinary shareholder, right? So he is the one with the most risk. Okay, so that's the one that comes first, the ordinary shareholder. Redeemable preference shareholder. His dividend percent, that how much ever that was, I think it was 8%, right? No, sorry, 5%. 5% is fixed. He will somehow get it. But if the company goes bankrupt, only after settling all the debt holders, we will come to the preference shareholder. So he gets second place there. Redeemable preference shares. Then between the bank loan and the loan note, you can see the bank loan is secured against the current assets. Okay. So if you really think about it, interest we will pay, but if in case we go bankrupt, the maximum they can take out is they can take our current assets, our inventory, receivables, cash. But they can't touch any of our non-current assets. Like if we have a building, or if you have a machine or a motor car or something, they can't touch that. So they, compared to a preference shareholder, the risk is less. But when you compare it with this loan note holder, who has it secured against the non-current assets, they are actually more risky. Because non-current assets only usually is of higher value. Okay, so the bank loan will come next. And the least riskiest investor is the loan note, because his interest also is set. And even if something goes wrong, we are not able to pay interest, we are not able to repay the principal, he can always claim our non-current assets. So he has least amount of risk. So the order will be one for ordinary shares, second will be the preference shares, third will be the bank loan, and fourth will be the loan notes. Okay. Right. So question 17, calculate the conversion value of the 8% loan notes of power company after 7 years. Okay, so let me do this since you need the question. Okay. Usually this doesn't happen. So this is the question. Calculate the conversion value of the 8% loan notes after 7 years to 2 decimal places. So I'll give you the information with regard to the loan notes. Apply the formula in which one? Which formula? For the loan notes? Question 17. Yeah. So if they're here, you don't need the formulas yet, because here they're asking you calculate the conversion value of the 8% loan notes after 7 years. Means they're saying, suppose we convert those loan notes to ordinary shares, what will be the conversion? What will be the value of those particular shares, basically? So it's actually, there is no equation for this. You have to figure out based on what we have. Yes. $131.12. Good. Okay. So this is actually easy, right? So we know that after 7 years, for each of our loan notes that we have, we can convert it to 8 ordinary shares. Okay. So 8 ordinary shares means simply we have to find out in 7 years time how much will be the market value of one share. Okay. So first thing is we have to find out the share price in 7 years time. Right. So if you look here, they're saying the current ex-div share price is 10.9 and it will grow at 6 per year. Okay. So currently it's $10.9. It will grow at 6% per year, means after 7 years, you have to make it 1.06 to the power 7. Okay. So you can put this formula, which is 10.90 into 1.06 to the power 7. So we are talking about 16.3896. Let's make this 2 decimal places. Okay, so 16.39. 7 years time, one share of yours will be equal to $16.39. So how many shares can we convert to? We know that we can convert it into 8 ordinary shares. So 8 shares into the market price of 16.39, the conversion value will be 131.12, like you calculated. Okay, so you just have to put that answer here, 131.12. Question 18. Assuming the conversion value after 7 years is 126.15, what is the current market value of the 8% loan notes of Power Company? Okay. Now here, understand this thing, right? even if you got question 17 wrong. Okay, now see, actually the answer is 131.12. That answer is not carried down here. They are saying assume conversion value is 126.15. Okay, so we will do the calculation based on this 126.15 only. Okay, that's the first thing. The next thing is, how do we go about this question, right? Now we know for every loan note of ours, if you convert, you will get one share worth, you will get 8 shares and all of them together will be worth 126.15. So in other words, basically your one loan note will be valued at 126.15. Okay. If you look at the other option, which is where you can redeem it on the same future date at a nominal value of $100, each of your loan notes will have a value of only 100. So obviously here the higher option is to go for the conversion, because when you convert each loan note, you will end up valuing it at 126.15. Whereas if you go for just the normal redemption, we will value it only at 100. So it's very clear here. We won't go for the cash option. We will go for the share option. Okay. So we know that we are going to convert. That's fine. Now they're asking you to get the current market value. Okay. So if it is a convertible, let me take you here again. The market value and cost of debt, the equations are more or less the same. Okay. How we do it is more or less the same. I'll show you the difference between the two. Okay. So if it's a convertible, first we will go and decide, okay, are we going to go for cash or conversion? Here we know we are going for the conversion option. Okay. Then after we make that decision, we have to do a calculation similar to an IRR. Similar to an IRR calculation. So let me show you how that calculation will be. Right? So IRR calculation means I'm not talking about calculating two NPVs or anything. I'm talking about trying to calculate IRR when it is an annuity. Okay, so let me show you how it works. You'll have the years here. Then you will have your cash flows. You will have your discount factor and you will have your present value. This is how it will usually look like. So if you look at this particular loan note from year 1 to year 7, the only cash flow that we will have is interest. Okay. And how much interest? It was a 8% loan note. Yeah. So 8% means to calculate the interest, you should do 8% into the nominal value, which is $100. Always that's how you calculate interest for a loan note. It's always the percentage into the nominal value. So 8% into 100 means interest is we're talking about 8. That's going to happen from year 1 to year 7. Okay. Then in year 7, we are going to convert. So the conversion is going to happen. So in year 7, we are going to convert. How much are we going to convert? At 126.15. Okay. Right. Now, usually, I'm telling you, if you want to calculate the cost of debt, okay, if you want to calculate the cost of debt, then you will have the market value. You will have the market value. Okay, so market value is basically the answer that you get here. In this case, they're asking you to calculate that. So in case they wanted you to calculate cost of debt, then your cost of debt will be actually here. You will have to work backwards. But in this question, they are giving you the cost of debt. They're telling you that it is 9% per year. Okay. So the cost of debt is only used as the discount factor percentage. So at 9% cost of debt. Okay, so don't get confused there. Okay. Then here you're getting present value. The answer, whatever you get, that is only the market value. Okay, in this case, that's exactly what they're asking you to find out. Okay. Right. So year 1 to year 7, interest 8, you need to make it a present value. Very clearly, you can see this is an annuity. 7-year annuity. So what you do, go to the annuity tables, go to 9%, find out what is the annuity factor. Okay. So since I have not done it even once in this TRG, I'll show you, but I'm sure you know how to do it. So we know it is an annuity. We know the percentage is 9 and we are talking about a 7-year annuity. So look at the 7 column. It's 5.033. So that is the annuity factor. Okay. So all you have to do is take that 5.033 and put here. Okay. So 8 into 5.033, that will give you an answer 40.264. Okay. Let's take it to 2 decimal places. Because usually the MTQs, guys, you won't have a spreadsheet. You will have to do this by hand. Okay. Only the section C, you will have a spreadsheet. So be familiar with doing it manually also. Okay. Right. So then we have the conversion option, which is 126.15 happening in year 7. This is not annuity, it's just a normal cash flow. So if you want to get the present value, you have to go to the present value table, 7 years, 9%, right? So this is the present value table. 9% for 7 years is 0.547. Okay, so let me just remove this. So here the answer will be 69. Okay, so then if you want to get the market value, just add the 2 up, right? So 40.26 plus 69, 109.26. That is the market value of this particular convertible. Okay, so that's why I say it's like an IRR styled calculation. Yes, thank you. Yes, those are the rates. So here, let's see if we have answer 109.26. So if you have a convertible, this is how we calculate market value. Okay. Now I'll just tell you there can be a situation where you don't have the cost of debt. Okay, you might not have the cost of debt. They might give you the market value. So in that case, what will you have to do? You will have to start working backwards. Okay, so you will have to figure out, okay, how much will this answer be if the market value has to be 109.26. Okay, and then actually it won't be so complicated. Like in this case, we need 2 particular answers. No, there will only be 1 line, either interest or conversion. Okay, so this is mostly it will be in the, when it is a redeemable debt. So in that case, you won't have a problem there. Basically, you will work backwards to get this percentage, KD. Okay, so yes, we will look at another question later where we will find KD. But in this case, we are finding the market value using the KD that they've already given to us. Okay. Just give me a minute. Let me see if I can show you the. So this is how it would look, right? So I told you there can be a situation where you can find KD. So in that case, you can see the market value will be given to you. Okay, so you put that as a negative. They'll give you the interest payments. They'll give you the capital repayment also. And then what will you have to do? Calculate IRR. So that's why I say it's like an IRR type calculation. So then you will have a different discount rate. You will have to take 2 rates. Here they've just taken 5 and 15. Calculate 2 different NPVs. And then you will have to use the IRR equation to get the IRR percentage. Okay, so that's how you work trying to get KD. So KD is a little bit more complicated because you need the 2 NPVs and the 2 discount rates. Okay, but when it comes to calculating market value, it's a lot easier. Okay. But if it comes in a section C question, I know I'm giving a lot of information at the same time. If it comes in a section C question, you are allowed to use the IRR function in the spreadsheet. Okay, so you don't have to do two NPVs, two rates or anything. You can just use the IRR function and calculate IRR. Okay, which I will show you maybe the next week or the week after that. If it comes in an MTQ, you don't have a choice because you don't have the spreadsheet. Okay. Right. Let's look at question 19. Which of the following statements relating to the capital asset pricing model is correct? What do you think is correct? I'll just look at the question and remind you something. They said the equity beta of power company is 1.2. Okay, so that's the only thing you have to remember to do this part. Okay, so I'll just explain this. While I'm explaining, it might make sense, right? So when you talk about betas, there are two types of betas, right? Asset beta and equity beta. Okay, so if you take the asset beta, we consider only the business risk. What's business risk? Can you remember I told you if you're having umbrellas, you're selling umbrellas, risk is it's not raining. Okay, so asset beta will reflect only business risk. Equity beta will reflect the business plus the financial risk of that particular business. Okay, so business risk means the fact that something in that particular industry is affecting everybody in the industry. Financial risk means it's very specific to your organization. It's to do with your debt equity ratio. Okay, so if you look at the first one, it's saying equity beta of PAR considers only business risk. That's wrong. Equity beta, naturally, we are talking about business plus financial. Okay. Then it's saying the capital asset pricing model considers systematic risk and unsystematic risk. Now, this you have to go through this area a bit. There are two types of risks also. Okay. One is systematic and one is unsystematic, right? So when it comes to unsystematic risk, it can be reduced by something called diversification. Okay, so diversification means you invest in many different industries. Like if you invest in umbrellas, you invest in sunglasses also. If you invest in raincoats, you invest in something else that is, that works in the opposite way to raincoats. So basically, unsystematic risk, the only way to reduce it is to do this diversification. So when it comes to capital asset pricing model, we assume that all our investors are properly diversified. So that means they don't have unsystematic risk. So only risk that we consider in the capital asset pricing model is systematic risk. Okay, so if you haven't gone through this area, just go through the CAPM chapter. It will definitely make sense. Okay. Third one is saying the equity beta of PAR company indicates that the company is more risky than the market as a whole. So we know that the equity beta of this company was 1.2. Okay. As a rule, there is a rule like this. If the equity beta is more than 1, that means we are more risky than the market. If it's more than 1. If the equity beta is less than 1, obviously we are less risky than the market. Okay. If the equity beta is just 0, that means it is equal. Okay. It's equal, right? Sorry, if the equity beta is 1. Okay. If the equity beta is 1, that means it is equal to the market risk. So here, since it is 1.2, which is more than 1, yes, it is correct. The equity beta of PAR company indicates that it is more risky than the market as a whole. Okay. Last point, they're saying the debt beta of PAR company is 0. They didn't talk about the debt beta at all. Okay, the reason why they have put this is when we do capital asset pricing model in our paper, FM, we make an assumption. We make an assumption saying that debt beta is always 0. Okay, because the reason is if we don't make that assumption, our calculations will become very complicated. Okay, so for all questions throughout the syllabus, we make this assumption debt beta is always 0. Okay, but we don't even talk about debt beta. We don't even explain what debt beta is. Okay, so although we make that assumption, that is not true in real life. And in this particular instance, power company, they are not talking anything about the debt beta being 0. Okay, so D can't be the answer. Right. Question 20. Which two of the following are problems in using the price earnings ratio method to value a company? So if you remember, I told you this slide that I showed you, right? This one. One of the methods to calculate cost of equity is this dividend valuation model. Because of the equation having market price per share, the same model you can use to calculate market value also. But if you look CAPM, proxy betas and all, you can't calculate market value because it's only giving you KE, right? So when it comes to calculating market values, this is one method. There are other methods as well. Okay, so I'll just quickly show you where to look for those methods. It's in a chapter called business valuation. Okay. By the way, if anybody is watching this later on, this is the order of the study hub. Okay, it's the order of the study hub. So if you look here, there are different approaches to valuing a company. You can have asset-based, income or earnings-based, and cash flow-based. Okay. So if you look at asset-based, you can either use your book values, the net realizable value, or the replacement cost. Okay. So that is just one method. Then there is another income or earning based method. So that is basically using a PE ratio. Okay. So in this question, what are they asking? They are asking you, I'll just read it out. Which two of the following are problems in using the price earnings ratio method to value a company? Okay. So just read through this. It's saying income-based methods of valuation are of particular use when valuing a majority shareholding. So first, there is a problem. If you want to value a majority shareholding only, this PE ratio is worthwhile. If you're talking about a minority shareholding, it doesn't make sense. Reason is, it is an earnings-based method. Only if you're a majority shareholder, you can influence earnings. If you're a minority shareholder, there is no way for you to influence the earnings of the company. So that is why only if we are valuing the majority shareholding, it's a good option to use the PE ratio method. Okay. So how we do it is, this is how we calculate PE ratio. It's MPS over EPS, market price per share divided by earnings per share. And then value of the company equals to the total earnings into the PE ratio. Okay, so these are so many equations that we can work around to get the value of a company. End of the day, this is how we get it. Okay, so the problem here with the PE ratio is, look at this point, it's saying, PE ratios are quoted for all listed companies. Meaning, if you are in the stock exchange, somebody will calculate your PE ratio because anyway, you will have a market price per share. But if you're an unquoted company, obviously you have a problem because you don't have a market price per share. So trying to get the PE ratio, it's going to be a little difficult. You have to find a similar company who is quoted and then adjust their PE ratio to kind of reflect your PE ratio. So that is another disadvantage of this method. Okay. So that's what they're saying. This is how you have to go for an unquoted company's PE ratio or a similar quoted proxy company and make adjustments. Okay. So that is another method, the PE ratio method. Then there is another method called the earnings yield method. It's similar to PE ratio. It's just the inverse. Okay. Now PE was MPS over EPS. Earnings yield is EPS over MPS. So if you want the value of the company, it will be the total earnings into 1 over the earnings yield. Inverse of PE ratio, PE was earnings into PE. So this will be 1 over the earnings yield. So we looked at asset-based methods, income-based methods. Then you have the cash flow-based method. So under that, see, dividend valuation model will come. Okay, because yeah, we used it to calculate KE. I'm not saying no, but the same equation can be used to calculate P naught as well. Okay, or the market value. So this is basically the summary here. So you can see, you can go for asset-based methods. Asset-based is easy. You can just go through it. Income-based means usually if it's a majority shareholding, you can either go for PE ratio or the earnings yield. And if there is growth in earnings also, you can incorporate it when there is earnings yield used. And under cash flow methods, you can use the dividend valuation method and another method called the discounted cash flow basis. Again, you will use that only if you have a majority shareholding. Okay, so this is just the summary of the entire business valuation. All the details will be there in that particular chapter. So if you feel you're not comfortable with all of these methods, then it's a good idea to go through the entire chapter. Okay. Right. So what are they saying here? Which two of the following are problems in using the price earnings ratio method to value a company? It is the reciprocal of the earnings yield. Actually, it's true. The earnings yield is a reciprocal of the price earning ratio, but that's not a disadvantage. They're just mentioning that. It combines stock market information and corporate information. Actually, it's true. We have the market price per share. We divide it by the earnings per share. That is a corporate information. Market price is stock market information. But why is that going to be a problem? That's not a problem. Okay. C, it's difficult to select a suitable price earnings ratio. That is correct. Because especially if you are not a quoted company, getting a price earnings ratio is wrong. Because like I said, PE ratio, it's a norm to calculate it for all quoted companies. Okay. But when it comes to unquoted companies, nobody is there to calculate it because we don't have a market price per share. So correct. C, it is difficult. So that's a problem. D, the ratio is more suited to valuing the shares of listed companies. Again, correct. Like I said, if you're a listed company only, you will have the PE ratio readily available for you to calculate. Okay. Right. So the answers will be C and D. Right. So the next question is to do with risk management. So I don't want to start it now. We obviously don't have time. So next week, which is the 20th, we will finish off this paper. And I will have another paper as well. Hopefully, we can finish off that paper as well by the 27th. Okay, so the plan is to finish off this paper. We will see a lot more areas that we didn't see. For example, risk management, we didn't focus, right? So today, what have we focused on? We have focused on the cost of capital. I have given you summaries of how to calculate the cost of equity, cost of debt, very important areas. And we have looked at business valuation also. Okay, so we have focused on that area. Next week, we will focus on the risk management area. Most of it, we will do risk management. And thereafter, we will plug in the gaps. Wherever we haven't seen anything much, we will plug it in on the 27th. Okay, so meanwhile, make sure that, hopefully by next week at least, you have 100% coverage. So now I can see some areas you were really good at, some areas you haven't gone through. So it's difficult for you to do the question. Hopefully next week, that problem will be sorted out. Okay. Right. So that's it for the day, Asjad. I will see you next week.
Thank you, ma'am.
Okay, no problem.
Thank you.